Welcome to the deep dive. Today we're looking at a company that is really presenting one of the most frustrating dilemmas you can find in finance. We're talking about Molina Healthcare, ticker
Mm,
MOH.
Right. And we're going to put this Fortune 500 managed care insurer through, well, the most rigorous screen we can think of, the classic Warren Buffett value investing checklist.
And the goal here isn't just to see if the stock is cheap, right? It's about whether it's fundamentally investable, given the current storm it's in.
Exactly. I mean, this is a company that's a huge part of the U.S. healthcare system.
Absolutely. We're talking about Medicaid, Medicare, the ACA marketplace. They served, what, about 5.6 million people across 21 states as of the third quarter of 2025? It's a really necessary business.
And that's the core of the conflict, isn't it? You have this history of, frankly, spectacular financial metrics that have just, I mean, hit a brick wall.
A total brick wall.
Profitability is down, cash flow has collapsed, and it's all happening under this cloud of huge policy and utilization risk. This is where a value investment starts to look a lot more like a highly speculative turnaround play.
So that brings us to the big question we have to ask you, the listener. If a company looks incredibly cheap on paper, based on its history, but its core numbers are failing right now, how much margin of safety is actually enough?
To even begin to answer that, we really need to understand their business because its specialization is both its most powerful weapon and its greatest vulnerability.
Okay, so let's start there. Let's talk about market positioning. Because when you put Molina up against, say, a United Health or CVS Aetna, it looks pretty small.
It does. Their revenue, maybe 44.5 billion in the last year, is only about, what, 2.5% of the entire health insurance industry?
And United Health has something like a quarter of the whole market. It's a giant.
That's true, but it's a little misleading. Molina isn't really competing for those big corporate accounts. Their battlefield is state-level government programs, specifically Medicaid managed care.
Oh.
And in that specific niche, they're actually a major player. They hold about 6% of the national enrollment, which makes them one of the handful of really big publicly traded Medicaid contractors.
So they're not just a small player, they're a specialist who is dominant in their particular field.
Precisely. This focus on government-sponsored care for low-income and, high acuity populations creates what you might call a regulatory moat. The barriers to entry are just huge.
You can't just start a company tomorrow and win these state contracts.
No way. You have to win these incredibly competitive requests for proposal, RFPs, and the sources show Molina has become an absolute expert at that.
And you can see that competitive advantage, can't you?
Oh, absolutely. The source material points to a great example, that sole provider award for Florida's Children's Medical Services Program. This is coverage for some of the most medically complex kids in the state.
And that one contract is huge.
It's massive. It's expected to generate an estimated $5 billion in premiums in 2025 alone.
Wow. And winning that kind of trust from a state, especially for a population that vulnerable, that's not just about being the cheapest bidder. That's about proving you have decades of experience.
It's a phenomenal edge, but, and this is the big but, when your entire business relies on the government, you are completely exposed to political shifts and regulatory changes.
That moat only exists as long as the government wants it to.
Exactly, and that risk has started to hit their financial engine and hit it hard.
All right, let's turn to that financial engine then, because looking back, the historical numbers here, they tell a really spectacular story.
They do. I mean, if you were only looking at the data through, say, 2024, Molina passes the Buffett test for profitability with flying colors.
Let's start with the good old days then. Buffett metric number one, returns on capital. The return on equity, the ROE, was a staggering 27.1% in 2024.
Which is almost double the peer average of around 15%. It's fantastic.
And the return on invested capital, ROIC, was also great, about 14.8% in 24, which easily clears their cost of capital, their WACC, which is only around 5.7%. These numbers just scream high-quality compounder.
They did. But now we have to pivot to the severe deterioration we saw in 2025. That 3-year average ROIC of 12.2%. It's now slid down to 9.8% for the trailing 12 months.
It's still above the cost of capital, technically, but that direction is what's so scary. It signals massive pressure on their margins.
And their margins were already razor thin to begin with.
Right. They were at 3.0% in 2024, which was already below their peers at around 4.7%.
And the reason for that compression is simple. Exploding medical costs. The key metric to watch here is the medical care ratio, or MCR.
Which is just the percentage of their premium dollars they spend paying out claims.
Exactly. And that ratio has climbed from 89.1% in 2024 to a really concerning 92.6% by the third quarter of 2025.
That is a massive jump when your whole profit is only 3 cents on the dollar.
It is, and 92.6% is actually higher than the company's own long-term target. It tells you something is broken down. Management themselves called it an unprecedented medical cost environment.
So the question for us as investors is this a temporary blip or a permanent shift?
That's the billion-dollar question. Is this just pent-up demand from post-COVID care finally hitting the system? People who put off procedures are now getting them.
Or is it something more structural? Like maybe the new pool of Medicaid members after the redeterminations are just sicker than the old pool.
And if that's the case, if patient acuity is higher, then costs are going to keep rising faster than premiums. And that just, it guts their profitability completely.
Which brings us to Buffett metric number 2.
Fair.
And for a conservative investor, this is really the ultimate test. Owner earnings, or, free cash flow.
And this is where the entire investment thesis for Molina just completely falls apart right now.
It's a critical failure.
An absolute failure point. FCF, it plummeted 65% in 2024, fell from over $1.5 billion down to just over $500 million.
But the real shocker is what happened next.
The real shocker is that for the 12 months ending Q3 2025, free cash flow went negative, a loss of $574 million.
Negative free cash flow. That just violates the most basic rule. You need a business that generates cash, not burns it. And this moves the stock squarely out of the value bucket and into the turnaround bucket.
Exactly. And to make matters worse, this cash flow failure is happening at the same time their leverage is going up.
Their debt-to-equity ratio. It had been coming down, but now it's climbed back up to nearly 0.96.
And do you know why?
Yeah.
Because management decided to use debt to finance about $1 billion in share buybacks in 2024.
That decision just seems stunningly poorly timed.
It's very hard to defend. They loaded up the balance sheet with debt to buy back stock, which, props up earnings per share.
Right.
At the exact moment their actual cash flow, the lifeblood of the company, was signaling extreme distress. It suggests a serious misjudgment of what was happening.
So this all leads to the operational fallout. This inclement weather that just hammered their recent performance.
It really did. You see it clearly in the Q3 2025 results. Operating income just fell off a cliff. It dropped from $467 million down to just $137 million year over year.
That is a shocking drop. That's the kind of news that sends investors scrambling for the exits.
Yes. And management had to come out and slash their guidance for the full year. They cut their 2025 EPS guidance from an initial high of around $24.50 all the way down to about $14.
And that massive cut is why the stock is trading at such a huge discount today.
It's the entire reason. So their plan now is purely defensive. They're trying to contain costs and reprice their plans where they can.
I saw they're proposing some pretty huge premium increases, like 30% in some cases.
They are. And they're also pulling back from the ACA marketplace, which they said contributed about half of that Q3 earnings drop. The strategy is clear. It's a retreat. Profitability has to come before growth.
But even if they can get their own house in order, they're facing this huge systemic risk coming out of Washington.
That's the shadow hanging over everything. The source material refers to this proposed legislation, the One Big Beautiful Bill Act, or OBBA. And this bill is a direct threat to their entire business model.
Let's be specific about the threat here. What does it actually do?
Okay, so from a purely financial standpoint, it has two major parts that could just wipe out their profits. First, it threatens to put work requirements on Medicaid recipients.
Which means fewer people would qualify, so Molina loses members and premium revenue.
Exactly. And second, it puts limits on something called provider taxes. States use these taxes in a complex but essential way to get more matching funds from the federal government.
So if that funding lever is gone,
then the states have less money, and they inevitably have to cut what they pay the managed care organizations, which is Molina's core revenue stream. It's a potential double whammy.
This volatility brings us right to what you call the valuation paradox. The numbers are screaming danger, but the stock price is flashing cheap.
The metrics look incredibly compelling if you believe this is all temporary. Molina's trailing PE ratio is around 9.4. Its price to book is about 1.85.
And how does that compare to their peers?
The average PE for their peers is closer to 15. So on the surface, they look severely discounted. The earnings yield is over 10%, while a 10-year treasury is, about 4%?
It passes that test easily.
It does, and here's the real kicker. If you run a conservative discounted cash flow model, even one that uses their last positive FCF year, 2024, as a starting point, it suggests a base case value of around $312 a share.
Wait, say that again. $312 versus a trading price in mid-November of what, around $142?
Yep.
That implies a margin of safety of over 30%. I mean, that's what value investors dream of finding.
It is the ultimate value trap scenario. The discount is absolutely real, but that entire valuation, that entire margin of safety, it all hinges on one massive assumption.
Which is,
That Molina can quickly get back to generating positive free cash flow and stabilize those margins. If FCF stays negative, that DCF model is worthless.
right. So that $142 price is basically the market telling you it thinks the probability of FCF staying negative is extremely high. That cheap PE isn't a sign of value, it's a sign of immense risk.
That's exactly it, which is why we have to look beyond the numbers at the more qualitative factors.
Okay, so we've got the price of a bargain, but the performance of a broken company. Let's look at management and insider confidence.
To be fair, on the positive side, management has shown some good cost discipline where they can. Their G&A expense ratio has improved, which is good to see.
But as we already talked about, their capital allocation decisions, like those debt finance buybacks, are highly questionable.
They are. I mean, the repeated guidance cuts combined with spending $1 billion on buybacks while cash flow was collapsing, it suggests they either profoundly misunderstood the cost environment or they were trying to mask the operational problems by propping up the EPS number.
And we have to look at what the insiders themselves are doing with their own money.
And this, to me, is one of the biggest red flags. Over the last year, insiders, the CEO, directors, they've sold a net of about $28.6 million worth of stock.
And how much did they buy?
Just $1.6 million.
That disparity is enormous. They are voting with their wallets and they are voting no, even while the company itself is buying back shares.
They're taking profits off the table at the exact moment. You'd want to see them buying aggressively if they truly believed the stock was a bargain. It's not a good look.
What about their customers? Do people like them?
It's a really mixed bag. Insure.com ranked them number 9 for 2025, which is good. They got high marks for price, but their net promoter score from another source, comparably, is a dismal -21.
So a lot of their customers are detractors. They offer a good price, but loyalty seems pretty weak.
Very weak.
Okay, let's tally this up against the Buffett checklist. The failures here feel pretty significant.
They are. Let's use a traffic light system. Red light, no growing owner earnings. FCF is negative, period. Red light, no high gross margins. They're thin and getting thinner. Yellow light, rising debt thanks to the buybacks.
But there are some historical green lights.
Yes. High historical ROE and a PE valuation that, on its face, looks fantastically cheap.
So what's the final verdict for a conservative investor? Is this a buy, or is it something you just watch from the sidelines?
The source material is very clear on this. It concludes that Molina should be categorized as a potential watch list candidate, not an immediate buy.
The discount is compelling, but the risk is just too high right now.
Exactly. The entire investment case hinges on things that are uncertain and largely external. You need policy risk to go away, you need utilization costs to come down, and you absolutely need to see a verified return to strong, positive free cash flow.
The final word is patience. You have to wait for the fundamentals to actually stabilize before that discount can be considered a real margin of safety.
So to sum it up, you have this structurally vital business. It operates in a niche with high demand, it has a history of great returns, but it's currently flying through a perfect storm of political risk and unprecedented medical costs that have completely vaporized its free cash flow.
And that storm has created what looks like a massive discount in the stock price. But that price really just reflects the market's fear that this turnaround might not happen. So here's a final thought for you to take away.
We know that the aging U.S. population creates this massive, unstoppable demographic tailwind for government healthcare programs. That's a certainty.
But in a niche like Molina's, where political decisions can wipe out your free cash flow overnight, how do you weigh that demographic certainty against such immediate high-impact policy risk?
What specific measurable metric, and I don't mean the stock price, I mean a real operating metric, like the MCR stabilizing below 91%, or maybe a full quarter of positive free cash flow, what would you need to see before you'd consider this an acceptable risk to take?
That's the deep dive for today. Thank you for joining us.